Welcome to the Deep Dive, where we take the latest earnings intelligence and synthesize it into critical, focused knowledge for you. Today, we're tearing into the Q3 2025 results for Hafnia, the global leader in the product and chemical tanker space. This report dropped just an hour before the U.S. market opened, setting a really fascinating tone for the shipping sector.
Yeah, and we need to understand the big picture here, the context. Hafnia reported these numbers as the tanker market is, well, it's definitely transitioning.
Transitioning how?
We're moving away from those, exceptional super cycle highs that we saw for most of 2024. Management kept saying we're moving toward a more normalized, but, and this is the key word, still highly profitable environment.
And that normalization piece is exactly why the market reaction was so telling. I mean, Hafnia delivered their best operating quarter of 2025, yet the stock closed down 3.2%.
Right. It just signals that investor expectations were maybe still anchored to last year's frenzy.
Yeah.
It's at a really unrealistic bar for Q3.
So the market was just trying to balance things out.
Right. Precisely. Weighing this really strong operational execution against the reality that the growth velocity is slowing down from the peak. And this tension is where the real deep dive begins. Was the stock drop an overreaction, or did it capture a genuine concern?
Okay, so let's unpack the headline financials right away. Operationally, what are we seeing?
The core engine is firing strong. Adjusted EBITDA came in at a robust $150.5 million. That's Hafnia's best quarter of 2025.
And the top line? The revenue.
Operating revenue based on the U.S. data feeds was $254.1 million. That was essentially right in line with consensus. I mean, it only missed by, $3.4 million? It's tiny.
Okay, but something had to spook the market, so where's the disconnect?
This is where it gets messy. It all came down to the earnings per share figure. The EPS Hafnia reported Q3 EPS of $0.18 per share.
And consensus was where?
Well, the standard consensus from the big institutions had estimates around 22 cents. So that implies a noticeable 18% miss.
A 4-cent gap. That's not nothing. That's enough to trigger some sell programs right there.
It is. But, and here's the fascinating part, there wasn't really clear consensus on the consensus. At least one other prominent data source had a much lower estimate, closer to 16 cents.
Oh, wow. So if you use that number.
Exactly. If you follow that lower figure, the reported $1.18 is actually a 12.5% beat. This confusion suggests the knee-jerk selling was probably based on a flawed benchmark. The market's initial reaction was suspect.
Okay, so regardless of that EPS ambiguity, one thing that is absolutely clear is their dividend commitment.
Crystal clear. They declared a Q3 dividend of $3.147 per share. That's a fantastic 80% payout ratio.
And I want to highlight the consistency. This is 15 consecutive quarters of dividend payments? In a sector known for volatility, that is true discipline.
Let's move past the headlines then and get into how they actually generated that cash flow. We have to start with the daily operating income measured by time charter equivalent, or TCE.
Right. What were the daily rates looking like?
Their average TCE was $26,040 per day. Strong rates. That led to total TCE earnings of $247.0 million for the quarter. But these results were definitely held back by some operational drafts.
We're talking about the off-hire days.
Exactly. Management reported about 740 off-hire days in Q3. That was a whopping 230 days more than they had planned.
Why so high? Was it unexpected repairs?
Mostly scheduled dry docking. So vessels pulled out for required maintenance, but they also had a couple of vessels undergoing these really complex cargo tank recoatings for chemical service.
Let's put that in perspective for you. 740 off-hire days at that average TCU rate.
You do the math. At $26,000 a day, you're talking about a loss of approximately $19 million in potential revenue. That amount alone nearly covers that entire 4-cent EPS miss we talked about.
So the Q3 performance was strong despite the friction.
Yes, and the good news is the forward guidance. They expect off-hire days to drop significantly, down to around 440 in Q4.
That reduction is huge. It improves utilization and sets them up for much stronger leverage going into 2026. And this ties right into their capital structure, which is probably the cleanest story in this whole release.
For sure. The key improvement is in the net loan-to-value, or LTV, ratio. This is a critical metric for shipping, measuring net debt against vessel value. That ratio improved a lot. It dropped from 24.1% in Q2 to a very disciplined 20.5% at the end of Q3.
That's a major move. And the significance of that 20.5% LTV is entirely linked to their dividend policy, right?
Absolutely. The LTV is the core trigger. They pay out a minimum of 50%, but if the LTV drops below 30%, the payout jumps to 80%. That's where we are now.
And the next big threshold is 20%.
The next threshold is 20%. Dropping below that mechanically triggers the maximum 90% payout. Being at 20.5% means they are right on the cusp of maximizing those shareholder returns.
And their liquidity position just underscores that discipline.
Totally. They ended the quarter with over $630 million in total available liquidity. That's about $130 million in cash and a big $500 million undrawn credit facility. When you look at their net asset value, or NAV, sitting at around $3.4 billion or $6.76 a share, I mean, they have a rock-solid foundation.
And they're using that foundation to actively reshape the fleet. They showed some serious capital discipline this quarter.
A huge amount of capital rotation. They sold 4 older MR vessels, ships built between 2010 and 2012.
Which seems to suggest they think asset values might be peaking, or they're just trimming the high-maintenance part of the fleet.
Could be both.
Yeah.
But at the same time, they took delivery of a brand new MR new build, the Hokkaido, and they exercised purchase options on 4 sale and leaseback vessels.
So the effect is what? A younger fleet, more owned vessels?
Exactly. They're making the fleet younger, and they're bringing more high-quality assets directly onto their own balance sheet. They're de-risking the fleet profile.
But the strategic moves that go beyond just owning ships, that's where it gets really interesting to me. They seem to be building out an integrated maritime platform, not just a simple shipowner model. Take the TORM stake.
Right. They advanced an agreement to acquire a 14.45% stake in TORM from Oaktree. Strategically, this is a big move toward consolidation in the product tanker space. It offers future synergies, market scale, and critically, management confirmed this TORM stake will be incorporated into the LTV calculation for the dividend.
So they see it as a core asset, not just a financial investment.
Precisely. It underpins their entire financial framework.
Then you have the Seascale Energy joint venture with Cargill. Why is a bunkering JV so important for a ship owner like Hafnia?
It just reinforces that integrated platform model. Seascale focuses on bunker supply ship fuel. That's a huge operating cost. By running a JV focused on bunkering, Hafnia improves its own fuel efficiency and supply chain while also, generating revenue from third parties. It's a brilliant way to capture margin across the value chain.
And all these moves, all these efficiencies, they funnel into one extremely powerful piece of forward guidance. Management said their operational cash flow breakeven should fall below $13,000 per day in 2026.
This is a crucial high-impact insight for you, the investor. That $13,000 figure is likely way below their cost of capital, and it's definitely below most of their peers. Achieving that low break-even transforms them from just a cyclical play into a structurally low-cost leader.
So even if the market rates drop to, say, $18,000?
Even at $18,000 or $20,000, Hafnia is still generating substantial cash flow, unlike some of their higher-cost competitors.
And the market rates right now certainly support that optimism. Their forward coverage looks strong.
Yeah, for Q4 2025, they've got 71% of their earning days already fixed at an average rate of $25,610 per day.
That's great visibility for the end of the year.
It is. And looking into 2026, they already have 15% of those days covered at over $24,500 per day. That's a strong base of guaranteed income that backs up their claim that the market is counter-cyclically firm.
Let's define that. Counter-cyclically firm. What does that mean?
Management attributes it to high clean petroleum product exports, especially from the Middle East and Asia, and strong global refinery margins. But the real structural strength comes back to the geopolitical picture.
It's all about the efficiency drain. Ton miles.
Exactly. It's all about ton miles. So that's just cargo carried multiplied by the distance traveled. When trade routes get disrupted, like forcing ships around Africa instead of through the Suez Canal, the distance increases, ton miles increase, and you need more ships to move the same amount of stuff. This sanctions-driven distortion continues to extend trade routes, effectively tightening supply.
And when we look at the actual supply side, net fleet growth is almost zero, which is a massive stabilizer.
A huge stabilizer. We're still seeing this LR2 migration. The LR2 is a large product tanker, but because the crude market is so strong, something like 88% of the new LR2s delivered in 2025 have migrated into the dirty crude market.
It's almost bizarre, isn't it? New supply that's meant for clean products is getting siphoned off by higher crude earnings.
That's why net growth in the clean trading supply is only about 0.5% this year. Plus, you have the sanctions on the dark fleet.
Right. Over 400 tankers are under sanctions, and about a quarter of those are in the product segment. That part of the fleet is effectively removed from mainstream trade.
Which brings us to the critical risk factor that everyone asks about. What happens if the Red Sea fully reopens?
Management's analysis suggests the impact might be less severe than people fear.
Their modeling is pretty detailed here. If Red Sea transits return to normal, The loss in demand from the longer routes would be mostly offset by arbitrage volumes coming back to the shorter Suez route. The net negative impact is estimated to be a minimum of only about 6 MR vessels.
That's a surprisingly low number. It suggests the market has already absorbed the new reality quite well.
It has. So if we look at the investment narrative, what does this all synthesize into? The stock has lagged, but the story is sound.
The thesis is shifting then.
It's definitively shifting. It's moving away from the 2024 supercycle windfall story toward a more sustainable, high-yield compounder with disciplined leverage and embedded optionality outlook for 2026. They're proving they can generate high, sustainable returns even in this normalizing environment.
That narrative shift from rapid growth to high-yield compounder begs the question, how do we translate that into an actionable move?
Absolutely. So let's dive into our segment. This is not financial advice. We are not licensed advisors. This is purely for entertainment, education, and exploring the implications of the data.
Okay, give us the outrageous but plausible pitch based on this deep dive.
My pitch leverages that LTV trigger and the persistent geopolitical backdrop. The thesis is go long Hafnia, ticker HAFN, via the Jan 2026 $7 calls. We already know there's active trading around that strike.
Okay, $7.50 is pretty ambitious. The stock is hovering near $6 now. What makes that plausible?
It's the mechanical LTV trigger. That's the internal catalyst. Net LTV is at 20.5%. With strong Q3 cash flow and that sharp drop in off-hire days for Q4, they are almost certain to push LTV below 20% by year-end. That automatically triggers the dividend policy to maximize the payout from 80% to 90%. That's a major positive catalyst.
So you're banking on a rapid mechanical re-rate based on maximized payouts. What's the outrageous component that gives it the juice to blast past the old high of $6.60 and hit that $7.50 mark?
The external factor, sustained geopolitical disruption. Management highlighted that Ukrainian refinery strikes are shifting trade from Russia to the U.S. Gulf, keeping ton miles high. So you combine the internal catalyst of the 90% payout trigger with the external factor of sustained high rates. Remember, Q4 is fixed at over $25,000 a day. That convergence provides enough upward pressure for a fast re-rate, spiking volatility and dragging the price into that aggressive $7.50 strike zone before January. It's a bet on financial engineering meeting sustained market tightness.
A truly comprehensive look at the confluence of events. So, to summarize our deep dive, Hafnia's Q3. They delivered their best operational quarter of 2025. They have robust forward coverage and a disciplined capital structure positioned to maximize shareholder payouts.
I will leave you with one final provocative thought that management raised, a key structural risk. As the geopolitical situation evolves, there's a serious concern that policymakers have to prevent vessels from the dark fleet, those with poor safety standards, from returning to mainstream trade if ceasefire talks progress.
Because allowing them back could flood the market.
Exactly. It could undermine utilization and collapse the entire strong market structure we've been discussing. It's just a reminder that, political stability comes with its own set of market risks.
A fascinating layer of complexity to consider. Thank you for joining us for this deep dive into the earnings intelligence. We'll catch you next time.